You can also determine, if it rises by 50 cents, that half of that delta will be added to the price of the option of approximately, let's say, 47 cents. So if the underlying Qs will rise by 50 cents, the option at the 50 strike price will rise by 47 cents. So it gives you an idea of what will happen as the market moves. Now you can tell that out of the money options, in this case out of the money call options, are priced at very, very little. They're very, very small asking prices here, 2 cents, 1 cent, 1 cent for most of the higher strike prices out of the money. That's because the market is not valuing the fact that they're determining that there's very little probability that as of today the Qs will rise into the $61, $62, $63 price range. That is quite a move for the Qs. But if we take a look at, let's take a look at another expiration date. Now, options have an expiration on the third Friday of each month. Actually, they expire the next day, which is the non-trading day. However, they're marked to market at the end of the third Friday of the month. In this case, the December 11 options will expire on Friday, December 16th. At that time, they will cease to trade. If you are long an option that is out of the money, in this case, let's say you were long the 60 call options, you will have lost the premium that you paid for that option, and you will not see any addition or subtraction in your account. Now let's take a look at a different month. Let's go to January for 2012, and you can see that the values of the out of the money call options are quite a bit different. In fact, they're more. You could go up to the 60 strike price, which was valued at only 1 or 2 cents on the December options, and these are priced at 55 cents. That 55 cents represents a if you want to, you could call it a hopeful anticipation that the market will rise to the 60, the Qs will rise to the 60 price level by January 12th. In actuality, in order for you to simply to break even on an out of the money call option, the Qs need to rise at $60.56 to break even on that particular option. And then anything above that would be pure profit. On the other hand, if you were to sell that option, you would receive 54 cents in funds into your account immediately upon selling it. And then if the market should stay the same, or even rise a little bit, maybe to the 59 level, or go down, you'd be able to keep that entire 54 cents that you wrote that option for. In other words, you wrote the option, someone else purchased it from you, and if they are wrong and the market does not rise to the 60 price level or higher, then you will be able to keep that entire premium that you received as the seller of that option. Now, there's a couple other things that, remember, we talked about delta, and that affects the price of the option. In other words, even if the market were to rise dramatically today, up another dollar to the 58 level, the price of this option will only increase by 24 cents. So if you were to purchase this option and the Qs rose another dollar to the 58 strike level, this option would only rise by 24 cents in profit. So if you purchased it at 55 now, it should be worth 79 cents if the Qs rise to $1. So the delta will determine how much you're going to be profiting today. The delta will change on a daily basis. But today, if it rises to 58, you should receive a 24-cent profit. you can see that the profit is greater as you go deeper into the money. However, the compensating factor, of course, is that they are more expensive. You can purchase a out-of-the-money call for 55 cents. You purchase perhaps an in-the-money call at the 50 strike price level at $7.27, and it represents about a 12 times more expensive option than the out-of-the-money one. However, if the Qs were to rise $1, you'd receive a 90-cent profit on this position, and on the 60s, you'd receive only a 24-cent profit. In the case of the 60 option, if the Qs were to rise for $1 and you receive a 24-cent profit, that represents about a 43% return on your investment. In contrast, if you were to purchase the 50 strike price option, with the 90 delta, if the Qs would rise by $1, you'd receive a 90-cent profit. However, the return on that investment is approximately 12%. So you can see the percentage gains are much greater for out-of-the-money options than they are for into-the-money options. But, of course, there is also a bit of a risk in both style of options if you're purchasing them and the stock drops. In this case, our ETF drops. You'd be losing money. The good news for the out-of-the-money option is that if the Qs drop by $1, you'll only be losing approximately 24 cents of your investment. That's still, on a percentage basis, a very large portion of your investment, about 42%. But you'll only lose 24 cents net. On the 50 option, on the 50 strike price option, if the Qs were to fall by $1, you would lose a total of 90 cents. So the total aggregate amount of your loss would be greater than it would if you purchased the 60s. So there are advantages and disadvantages of both style of options, either buying in the money options or at the money options or out of the money options. And to help you determine how much profit or how much loss you could actually have as a result of purchasing those options, all you have to do is look at the delta, and based on a single dollar move in the Qs, you would determine immediately what your profit or loss was during that price move. The same thing is true for put options. If you take a look at the deltas, you can tell, and now deltas for options are always negative. That means that as the market drops by $1, you will gain 18 cents if you were to purchase these 52-cent puts. And if the market actually went up $1, you would lose 18 cents on these 52 puts. The strike price 52.